Hey, what's going on YouTube? We are going to go through MGM Resorts International, ticker symbol MGM. This was requested by one of you guys. And we're looking through year to date, down about 6%. Over the course of 1 year, only down about 2%. We come over here, we can see we got a forward PE on this one, trading about 15 times, and also a forward EPS at about $2.76 per share there. And once we get over the 10Q, we're going to maybe make a little adjustment to that forward-looking EPS as well. I feel like there's something that we can change that actually makes it look a lot better than what it is right now. So they reported their earnings May 1st, beat on top and bottom lines with a pretty nice beat on both actually. And also we see analysts in the last 90 days had revised their expectations higher, with one revised lower there. And we can come down here a little bit. We can get an idea of the EPS expectations for the next coming quarters, looking like Q2 about flat with Q1, but beyond that, looking like we're starting to creep into some growth again in MGM Resorts. So I'm going to hop over to our financial spreadsheet and just kind of take a peek at how this company has performed. And we're going to come over here, look at our charts. We've got our revenue, gross profit, and net income right here. We can kind of see, it almost appears as though if you eliminate the 2020 dip that they had, kind of getting back on trend. It was as to where they the track of where they used to be. So, and then come over here to net income is very just up, down, and up, down. Always typically positive except for the one fluke 2020 year there. Otherwise, they are typically in positive territory on net income, but not really growing net incomes. Down to gross margins, we can see 41.7% last quarter. Trailing 12 months sitting at 44.1%. So pretty decent gross margins. Over to net margins, though, net margins aren't as great. So we can see margins are just kind of just all over the place, not really consistent on the overall net margins, but currently last quarter sitting at 5%, trailing 12 months 5.4%. Down to return on invested capital, sitting at about 16%, so pretty good. PE ratio, based on history, we're kind of trading at a near all-time high-ish on PE, so could kind of tell you it's a little expensive right now. Cash to short-term debt, we can see short-term debts here, almost enough cash to cover its short-term debts. Down to cash to total debts, as we can see, not nearly enough cash to even put a small dent into our total liabilities. Price to sales, though, pretty good down here below 1 on a price to sales basis, and in 2020 sitting at about a 3, and obviously other years prior much higher than that even than currently. Free cash flows, pretty good free cash flows though on this one. Nothing to complain about there. Capital expenditures used to be significantly more, and they've brought those into check quite a bit, growing a little bit, but leveled off as of lately. We got share count dilution. This company buys back shares very, very heavily, which is what we're going to adjust once we get to the 10Q to give us a different future EPS expectations for this the next forward-looking 12 months. They also used to offer a dividend, as you can see here, and as soon as COVID hit, they eliminated that and have not yet brought that back. I think what they're doing is instead of paying a dividend, they're buying back a lot of shares, and right now their current share buyback program I think is about $1.7 billion left over in that. So over to their 10Q, we're going to start on their balance sheet here and look at their cash to debt position. Currently they're sitting on about $2.7 billion in cash, slightly down quarter over quarter here. We can see it used to be closer to $3 billion there last quarter, so down a little bit there. And you come down here to operating, so this one we can eliminate a little bit out of the overall debts, which is actually going to make this look a little bit better. So we come down here to current liabilities. We've got $2.7 billion in cash. We know that. We just saw that. And then they got $3 billion in short-term debts, which is right here. We got $3 billion in total current liabilities. All of these are legit. There's nothing we can really kind of take out of there, like deferred revenues or something like that. So really, that's what we're looking at for a current cash position of about negative $300 million. So balance sheet, not great, but it's not terrible either, since they do have positive free cash flows. But we come down here to overall total debts. So we're looking at this big one here, $25 billion in operating lease liability. So this company no longer is ownership of its current resorts. It actually did, it's separated. So now there's MGM Properties or something like that, MGM Growth Properties. And then so they now MGM Growth Properties owns the properties. MGM Resorts pays leases to that property, that separate company. It's a sister company, I guess you'd say. So they pay leases to that, but then we come up to here, operating lease in the assets column. So this is saying that they've got cash for that. So then this kind of eliminates some of these lease liabilities that will eventually happen or they'll have to pay for. So that still is not nearly $25 billion. It's only roughly $1.2 billion that they're in the differences there. So not nearly as bad from that perspective. So cash to debt isn't as bad as it looks on the charts that we were just looking at a little bit ago. So overall, cash to debt, not great, but it is not nearly as bad as what it looked like there for a minute. Down here to overall income statement. So we've got 12% growth year over year on revenues, and this is at over a quarter. And then we can see down here on expenses, expenses were up 21.4%. So that's definitely concerning. But here's where it came from right here. All these expenses, I mean, some are, the majority of them are up a bit, but not, this is the one that really takes the cake, is gives them a benefit, whereas this is a cost. So they added $396 million or subtracted $396 million from their overall expenses, whereas here they added $17 million. So this is where we're going to adjust our current EPS, is by just taking out the property transactions that they have occurred in the last 2 years there to kind of give us a more stable EPS rate. Probably made a transaction that didn't cost them money, but made them money of $396 million. Either way, they made $396 million. So that got subtracted off of expenses and added into operating income. And property transactions this year was a $17 million expense, so that gets subtracted off of your operating income. Now, if we do eliminate that column there, that property transaction column, to give us a more potentially stable earnings per share, last year they did about 334 million in operating income in comparison to 730. This year would be 475 million for a year-over-year increase of 26%. So their overall operating income in theory here is actually growing much quicker at their overall revenues. Then we come down here to net income. And last year, we would be sitting at about $84 million of a net income if we were to subtract out this property transaction. Whereas this year, we're sitting at about $316 million if we, subtract out that $17 million expense. So overall, we come down here, we can also see that the share dilution, they went from 378 million shares all the way down to 323. So they bought back like 55 million shares in 1 year. So that just kind of gives you an idea how aggressive they are right now with their share buyback program. So instead of paying a dividend, they're buying back a whole bunch of shares. So down here, what we're going to do, we'll plug this into our financial calculator once we get to it for a final valuation on what MGM could be worth. And what we're going to do is see, real quick math, is $316 million net income that we just did right here this time last year, divided by 324 million shares outstanding, gives you about 97 cents this quarter times 4. You're looking at about a 3.88 EPS. And that's not including the aggressive share buyback that they have currently. So let's say they buy back another 10 million shares this year, okay? That's on the low end, obviously, because they just bought back 55 million shares. What's to say they're not going to do that again? So we're going to do this on the low end at 10 million shares this year. Then our future EPS could be around $1 per quarter or $4 EPS forward looking. So obviously that is also not including any net income growth either. So in our calculator, we're going to use 4.0 for our future EPS. Once we get to it, we'll use current EPS and then we'll use future EPS as well. And currently they do have $1.7 billion left in their share buyback program. And that could repurchase up to about 40 million shares at today's price. So definitely a lot of potential there for some significant EPS growth. Now over to our cash flows. So company currently sitting at stock-based compensation has about $27 million in payouts. It is up a bit year over year there. And we also have property transactions. So this does get adjusted back into cash flows. So that makes our cash flows more balanced because this is cash flowing in and out of the business, right? So this is an expense because this cash got flowed back into the business and was a benefit, whereas cash flowed out of the business here. So that's why it's an expense on the cash flows. So down here, we got cash provided by operating activities of $549 million. So we take that minus off our capital expenditures. It leaves us with about positive free cash flows in 3 months of $377 million. Then we come down here, repurchase of common stock. They bought back $506 million worth of shares in 3 months this quarter. So very strong buyback program, which we were very well aware of. So still continuing to buy back shares. And this time last year, similar amount of money paid towards share buybacks. So overall net change period for cash, we can see down $206 million off of the $3 billion. Leaves them with about $2.8 billion in cash currently. Back over to our valuation spreadsheet. We're going to compare MGM to 3 other competitors here. So we're going to scroll down here to our charts for comparison on the charts anyway. And we can see market cap, MGM, much higher market cap than everybody else. Also, revenue, gross profit, net income, similar story, much more revenue. But you can kind of see on this yellow bar, maybe not the highest net income either. So that kind of gives you an idea where MGM might be. Overall growth too, we're not seeing much for growth. This CZR here, much more significant growth, at least on EPS. But for the most part, not seeing very dramatic growth in this industry yet, at least forecasted. We've got gross margins here, 44%. Operating margins sitting at 10% and profit margins all the way down at 5%. So not the best margin business, at least what we can see. So we come to free cash flows. Pretty good free cash flows though. In comparison, return on invested capital, much, it's hard to see here because this one's kind of screwed up, but 16, 12, and 16%. So margin or return on invested capitals are pretty even across the board, except for this last one there. And overall PE, kind of paying in the middle of the range of the other 3 competitors here. Looking like 11 is a more reasonable PE, price to earnings, but it doesn't tell you that these 2 companies are worth buying either though. So overall, in a comparison, margins aren't the best. I would potentially look at maybe Win or CZR here potentially, but overall margins are not too exciting for me on this one in comparison to the competition. So over to our valuation calculator. So we got pretty much valuation here. Currently, we're plugging in today's EPS and today's PE ratio. That gives them a pre-launch fair value of $18. Then we come over here to multiples comparison, $39 per share. Price to book, 5-year average 3.27, today 3.32, so right in line with 5 years. PEG ratio telling us the PEG based on price to earnings divided by growth is very overvalued right there. Graham's valuation giving them $41.46 per share, does not offer a dividend anymore, so there's no dividend discount model. DCF valuation, analysts have a growth rate of actually negative like 3% on free cash flows. I'm going to give them the benefit of the doubt a little bit on free cash flows and just assume maybe they can grow them at 5%. So let's assume 5% growth rate on free cash flows. That gives them a DCF price per share of $72.14. Rule 72, we're looking at a future EPS potentially of about a 12 depending on growth, and that gives us a fair value of $27.05 per share. And then to the summary, so our final valuation based on today's numbers, we're looking at $39.58 per share. So slightly trading a bit above where our current fair market value is. Analysts do have a price target on this one of $54.62 per share. Now, what we're going to do, like I said, is we're going to plug in our forward numbers here. We got a 4 for our future EPS, which I just explained. And maybe you agree with that, maybe you don't, but that's what I'm going to go with. So we got a future EPS of 4, which then if you divide that by, our current ticker price, you divide 42 by 4, it gives you about a 10.5 for a PEG or a PE ratio. That gives you a pre-launch fair value of 28. Here we got multiples comparison, $60 per share. We still have a pretty significant PEG ratio. Even the forward looking is really richly valued, which actually that one wouldn't have changed. So our forward looking PEG would actually be this one here because we already plugged in our forward looking numbers. We got Graham's valuation, $63.78. DCF will not change. Our current Rule 72, we can increase our future EPS slightly here. We'll do a 16. Gives them about a 36.07 for Rule 72 price tag. And then overall, that puts us right at $52 and a penny. and 30% margin of safety, $36.41, and that puts us just slightly below analyst price target on MGM there. So over to our stock chart, technicals. We are on the monthly chart here, and we can see on the monthly chart going all the way back to 2009, we have this blue line, which has been broken in 2020 and broken at in middle of 2022. But other than that, this line is very well intact. Every time it hits it, it bounces off. We are near it. I think we do have some potential pullback here down to maybe $34, $35 per share. We do have some support at about $34, $35 per share. And if you look, that is roughly in line with a 30% margin of safety on that. So if that does pull back, I think we've got this blue line, which is very strong support. We've also got this purple line, which appears to be a form of support as well. So if we do get a pullback, maybe into this little channel here over the next maybe 30, 60 days roughly, depending on how quickly it gets there, it might not get there, who knows. But if it does, I think this could be potentially a great buying opportunity on MGM. I really like their share buyback program. That's only going to make your shares more valuable as time goes on. And they're very aggressive with that buyback program as well. So overall, what I'm looking at on MGM is just sit and wait and see if this thing pulls back a little bit. If it pulls back a little bit, I think it might be a great buying opportunity on this business. That is it for MGM Resorts. If you found value in this video, drop a like, subscribe, comment. We'll be back later with another stock analysis video.